Hello and welcome to Moneycontrol. Well, this year started off on a cheerful note, but it seems like some kind of trepidation is setting in and the markets look a lot more volatile. Nevertheless, we are sitting somewhere close to the top, and from here we don't know whether we are going to climb new peaks this year. We might go sideways or we could trek down. With me, I have somebody who has seen these market cycles play out over many years, Raamdeo Agrawal, founder and joint managing director at Motilal Oswal. So Raamdeo ji, first I wanted to start it off with this question, a macro question really. On one hand, we have the India growth story, which is, we all know that we have this demographics in our favor. We have this China plus one narrative. We are the fastest growing large economy. That is on one hand. On the other hand, you have global liquidity being pulled back. Put these two pictures together. What is the overall picture you see for India?
So let me first tell you, I'm not a macro guy. I would rather listen to some people who actually know the things. Like today, RBI governor saying, we'll grow at 7% next year. And our inflation will be about 4%. I don't have to ask 1,000 analysts who don't know what they're saying. I would rather listen to RBI governor and my finance, government officials who are giving some kind of projection. They're also talking about a projection. So 7% could be 7.2 or it could be 6.5. But we are getting broad guideline. So if we take it on the face value, 7% growth, 4-5% inflation, we're talking about 10 to 11%. I think 10.5% is the projection for nominal GDP growth rate. So about anywhere between 10 to 11% kind of nominal GDP growth rate. Now it is our expectation. My head of research is saying that next year will grow at 15%. This is a number I take for a broader picture. So that's where I stand. In a given situation, we'll grow at about 7%. We'll still remain the fastest growing large economy. I think one of the things you didn't mention, a lot of things can happen on a macro basis. That also redefines a lot of things. Like in a company, we have seen companies come up because of the leadership. It's not that it is anybody's birthright to win or lose. Particularly win. If you are a 1%, how do you become 20%? Right. Like HDFC Bank in 95, then opened the door, they had nothing. Today they become 12% of the total banking system. Right. So obviously something must have gone right. Just by sitting, you cannot go to 12%. Right. And become the most aspirational bank in the world. Right. So obviously the leadership must have done right things in a given opportunity. Right. Now Indian economy has an opportunity right now. How exactly our leadership, political leadership, is tackling this, harnessing this particular opportunity. That we have, and I think the biggest excitement of India is that we have very stable leadership after 30 years of coalition government. And now this leadership also is matured in terms of 2 terms. So first term was big challenging because a lot of changes were there. In second term, particularly in the second half of the second term, they are getting their kind of act together, and the growth momentum is picking up. Right. I think this momentum will be taken into the third term. Right. And I think it will become far more vigorous as we go forward. So I would rather look at that way. I'm optimist by birth. So I don't want to challenge what these guys say. If things don't work out, it will be visible in the quarterly numbers, And and I don't think RBI governor is going to say when they are going to do 4%, then if he says that we'll do next year 7%, he will be discredited. That he will never do it. So I would not bother too much about the global macros, on which I don't have any authority. I would rather look at back home and just go about picking stocks.
Fair enough. So in terms of stock market itself, obviously the market buys into this narrative that there is a redefining that is happening because of the leadership. And that is why the markets rejoice when there is state election victory. Now there is more optimism about general elections and so on. How much of stock market movement have we really front-ended? Because the key risk to a good growth story is always that the stock market is a future discounting mechanism. You tend to discount it much faster than the events play themselves out, right? Where do you think we are in that cycle?
So I would think that 80-90% of what would have been a thing if the current dispensation continues. When the mandate happens on 16th May or whenever that date is, March or May, something like that. The new government is supposed to come in power. So that day, if we had too much of uncertainty, this election had gone bad, there would have been a lot of volatility and a lot of speculative fervor. But that is killed after this last election. So I would think that a lot of certainty is coming into the power. Now the issue is that is he going to come with all-time high seats, and those kind of things are being talked. So clearly, in my mind, there is no disruption, and by chance there is a disruption, like 0.0001%. There is a chance that it's a democracy at the end of it. If there is a disruption, yes, we'll have some setback for some time. Then we'll see what happens from there. Country's story is not dependent on one event. Country's story is much longer. Maybe we'll have pain for a year or two, but that's fine.
Fair enough. Now let us just go back to market cycles in India itself. And you've been in markets since 1989? 1980. So you've seen a lot, right from the Harshad Mehta boom to the dot-com boom bust to the infrastructure boom in 2003 to 8, 5 to 8. Go through all those three cycles and tell us, how did you go through them? What were your key takeaways and learnings from those cycles? And where are we, if you were to map our markets today and retrofit it into, the cycles of the past, where are we today?
When I look back, I started in 87. We opened the doors for Motilal Oswal in 87. Though I'm in stock market from 1980 as an individual investor. So I've read everyday economic times from 1980 to till date.
I hope you read Moneycontrol now.
Now, of course, everyday Moneycontrol. So first bull run actually happened in 85, 86. That time I didn't have money. I was not in the market. But I watched it. It was quite a powerful bull run when Rajiv Gandhi and VP Singh combination came into power. It was a brief one. I think market doubled or something. But that first flush of bull run was visible. Boom bust cycle in India. Then I think it went up to about 800 or something index, Sensex I'm talking about. Right. And then it came down to about 400 or something, or a little lower than that, 330 or something like that. Then in 88, 89, it started building up again. In 89, 90, it was more like 700, 800 kind of a Sensex. And by 92 March, in 19 months, it scaled to 4,200. 6x in just about 18, 19 months. It is a kind of boom I don't think any major market anywhere in the world would have ever had. Right. Maybe Nikkei might have done, but not in this scale that in 19 months it was done this much. So that time we had just about started our work in Motilal Oswal, and we started with zero balance. We ended up with 30 crores of portfolio. So that's the power of what you call bull markets, and that's why the people love the bull markets. It brings a lot of wealth. And also it dissipates in the sense that the 30 became 10 the moment it collapsed. But that bull run was not about fundamental at all. Every bull market has a different definition.
Correct.
And it is not, if it is fundamental, then it's not a bull market. Right. You are getting paid for what you are.
Right.
So that's not bull market. Bull market is something where you get overpaid.
For what you are
doing. Or
you
get paid for nothing,
Correct.
That's the bull market.
Right.
So, so that's what happened in 92. Right. All junk companies went through the roof. Now, so it went 7x. Okay. Y2K was a very sectoral thing. The rest of the market were in dumps in 2000. HUL and all these kind of things were in dumps. Only tech stocks went through the roof. Out of nowhere, people found this software thing. I didn't know difference between software and hardware in 96. And then we made tons of money in Infosys, Satyam and Mastech and all those kind of companies, Hughes Telecom and all. We learned a lot of money. VisualSoft also one of them. I didn't make any money, but yes, it was there. So we made like 10x in 2-3 years time.
Right.
That was a big one, sectoral one. Then it collapsed again. Again it became 1/3. Then in 2000, so that was sectoral and led by whatever global. That was the first global bull run. I mean, we followed the global trend.
Correct.
And we understood what is Nasdaq.
Yeah.
First time we came to know about Nasdaq. 2003. Then when things were after 9/11, things were very dull, and we thought that it's the end of the world type.
Right.
We incurred loss for 2-3 months.
Right.
Then it started the mother of the bull run. That is 2003 to 2008. We expanded 100x in 5 years. We expanded 100x. And at that point of time, the bull run was completely fundamental. It was driven by commodity bull run and rise of China.
Right.
Vertical rise of China, and that drove the whole world. And then it actually ended up in a mortgage kind of crisis in US. They overextended themselves, and finally it became a meltdown in 2008. And then we were struggling and things like that. So these three bull runs have three different colors. So I'm sure this one also will have a different color. But it looks, this one, the one which we are in right now, 2020 post-COVID till date, I would say, say March, February, I think, February 18th or something like that, we made the bottom. The day on which Prime Minister announced that lockdown, 24th March, I think.
23rd March 2020, yeah.
So that's the bottom of the market.
Right.
Okay. So that from there the bull run has started. So what, 23rd March means 2020, isn't it? 21, 22, 23, this is the fourth year.
Correct.
So we have done quite a bit of it. And we have come from 8,000 to 21,000. So we have already done 3x. Another 3x is left. Okay. Now how, if we...
So every cycle you're saying is 6x.
I'm just mathematically doing it. Okay, from, that was 7x, 6x, so something like that. So we have done halfway, another half is left. If we do it in 3-4 years, we are very well off. If we try to do it in 18 months, then we again have a problem. You know, the market should not go in parabolic way because value is being created in linear fashion.
Right.
The market price should not go in non-linear way. That is very necessary. Good thing is, in 92 there was no SEBI. Now we have a very powerful SEBI. Regulators are very powerful and they have digital tracking. Who is doing what? That time, nobody knew what the hell is happening. But this time, I mean, it is for the regulator to decide what they want to do. But they can see every single trade is seen. So I think they have a lot of power. They will control. I'm sure they will not allow the market to go parabolic.
Sure. So assuming that we are in the third year of the, you said we can't call it a bull run because first of all you have to actually you have to answer that question. Are we in a bull run?
Yes,
are we
it
already
is a perfect bull run. People are getting paid for
nothing.
For not nothing, but they should
overpaid.
get
People are getting overpaid.
Overpaid, yeah.
Where are they getting overpaid? Across the board?
No. Not. It can never be like that. Even in 92, there were some pockets which were not couldn't participate. So yes, there are pockets which are not fully priced, or maybe there are some values left there. But in a lot of pockets, there is some small cap companies, some mid cap companies trading at. I believe one of the numbers is in S&P 500, about 170 odd companies are trading above 50p. Above 50p. And I think in 2008, it was only 67 or so at the peak. So you see when you do this kind of stuff, how many companies are trading in above 50? Because after 40, 50p, few companies will do well. Most of the companies will come back to whatever their long-term averages are. So you are going to be disappointed by paying high P. You know, so clearly markets in that sense is, but there are companies which are also trading at 10p, 15p. So I think still market has some pockets where it has completely not become South Bombay kind of price.
Sure.
Across the board, South Bombay price is not there, but it's difficult to find.
Okay. So now looking at the 3 cycles, we talked about the 3 cycles. What were your learnings from all those 3 cycles in terms of what opportunities do you buy? What opportunities do you pass? Because at least in the last, from last 2-3 years, if you see, every time market pulls back, there is a lot of strength. It gets bought into. So, as a philosophy, at least the Indian public believes every dip has to be bought. That is how we have behaved. Are there any principles in terms of how you look at, buying or fall? And if first of all, do you believe that in the next 2-3 years, a sharp correction will be ruled out, can be ruled out?
See, what I do, I'll tell you. First thing, I'm 100% invested at the top as well as at the bottom. That's my principle. I've never been in cash because it is beyond my capability to call the top and then sit through the entire fall and call the bottom also. I think somebody can call the bottom or somebody can call the top. Both cannot happen, and unless both happens, there's no point in calling.
Right.
Isn't it?
Right.
So basically, I don't get into that game. But I remain fully allocated to my capacity. So if I have 100 crores, I will buy stocks of, and not 99.5. I'll buy stock of 100 crores. That gives me, then my problem is not whether I'm in the market or not. Okay, so that worry is gone.
Right.
So then within that, what to buy, that is a question, what stocks to buy, which sector to bet. Those are the issues which keeps us busy. But allocation, I am very clear that, and I tell the client, if you are 50% equity, please be allocated 50%. Your risk appetite is for 25, go to 25. So that's the way I have worked so far, and it has worked brilliantly for me. Despite 2-3 cuts. The price I have paid is, I have seen 3 cuts in my portfolio of more than 50%. 92, 2000, 2001 and 2008. But theek hai yaar. In 30, 40 years, you see 3 cuts, but beauty is, in 1 year it comes back, full it comes back. So
that means you're getting the selling part absolutely correct. Because stock-wise, agar aap dekhen, to, in 2000, if you see, and I remember you saying that, one of the learnings from that cycle for you was that you thought quality will sustain value, but even Infosys...
Now I tell you, Infosys, I did sell it close to top, 80% to the top. But what I did with that money, I bought junk, which went zero and never came back. At least Infosys, after 3 years, it came back.
Right.
So I would have been better off not doing that. That's the learning of the past. So see, in bad times, in this kind of a roaring time, you like to compromise on the quality, because what happens is the good quality stocks move first, and behind that, what happens is the lower quality stocks start moving, and you want to be part of the action all the time. Right. So what you start doing, you start selling high quality. Your portfolio. You start keep diluting, and finally, what are you left when the dust settles? Someday dust will settle. That day you have all the junk in your portfolio, and that all the way it goes to zero. You took the portfolio from 1 to 100, and at the 100, all the junk, it comes down to 5 or 7 or 10. So market will go down by 50%, you'll go down by 80-90%, and you'll never come back to the market. The experience will be so bad. So the issue is that I think the trend is external, the liquidity flow is external. I can do nothing about it, but it is happening. So that will happen. Now, how do I take care of myself? So I would stick to my investment philosophy. I will always stick to my investment philosophy. If something doesn't permit my philosophy, it feels bad to see that stock is doing well and I don't have in the portfolio, but it's fine. I'm reconciled now. And second is that it is not about one stock performance. It is about 100% of your portfolio.
Right.
Your 100 crore portfolio, 5 crore stuff has gone 5x.
Right.
And rest of the portfolio is sunk. Right. What is the meaning? You better focus on the entire portfolio so that portfolio gives you 20-25% return rather than focusing on one single stock.
So what is the learning from that? That, there is a huge redeployment risk, especially if you today look at, a lot of people. If you were successful in the last 1 or 2 years, if you've made a lot of money, you've probably invested in a lot of themes that have done exceptionally well this time around. Yeah. So how do you, reorganize your portfolio at times like this? For example, anything that has gone up 3x, 5x. What is your, how do you evaluate? Because you might think that it is fair price, but is it okay to sell at a fair price? Should you allow your prices to run?
No. See, if the stock is good and I think there's still a lot of steam left, I'll stay. Okay, I'll stay. See, there are certain long-term commitments or long-term
steam left in terms of earnings,
of growth.
In terms of growth.
Growth and
not in terms
value
of
creation, both. Say, what deserves to be 30p has gone to 50p. But it is the earnings can scale up by 25 times. Theek hai yaar, we'll have some correction. But the final journey, say something has gone from, say, from 10,000 crores to 50,000 crores market cap. Okay, it should be more like 30, but it has gone to 50. Now, should I get out permanently? But I think it is going to go to 5 lakh crores. The potential is 5 lakh crores. So if I get out at 50, yes, for some time it will look a little lower, but the stock is gone. When it actually scales up to 2, 3, 4 lakh, 5 lakh, I will have nothing. That happened with the HDFC Bank. I had 5 lakh shares of HDFC Bank at $40, way back in 96. I have zero. Because I smartly sold at 15 rupees higher. And I never bought it back. So, when you get a good idea, see, this country is trended. Mark first thing. This country is trended. This 6-7% growth is not for 1 or 2 years or 3 years. It might become 5, it might become 4.5, it might go to 9, 9.5. But this around 6% growth, it is to go on for next 40, 50 years.
Right.
Then also we're not done. In fact, all the intelligent guys are asking, why don't we grow at 9-10%? I said, Gurudev, theek hai. Deliver me 7.
Right.
That will give me 12, 13%, 14% return.
Right.
Which is a lot.
Is there any risk that the returns that we make in stock markets, do you think over longer periods, the way the markets are discounting growth and earnings, is there a possibility that stock market returns may trail economic growth rate?
Quite possibly. If you see 40 years track record of Indian stocks, they've done around 13% ex-dividend. Another dividend percentage, so that will take it about 14% total return. I'm talking about from 1980, okay, which is very decent.
If you assume a certain economic growth rate for a long time, what are the chances actually that stock market returns might trail them, and what are the chances that it might actually overshoot?
So both are to do with the corporate profit to GDP. So how the corporate profitability shapes up. Now corporate profitability is a function of a lot of things. One is of course interest rates, global interest rates, local interest rates, commodity prices, because all over the raw material cost is commodities. Then you have the labor laws, then regulations, how generous is governments in terms of promoting entrepreneurship. Now today all the states are promoting. Incredible Gujarat, incredible Orissa, incredible Chhattisgarh. So it's all happening. So as if there's a golden era for entrepreneurship in India. So it all depends on that. What kind of subsidies they give, what kind of incentives they give, how good is the infrastructure. The entire infrastructure development is going to finally tell you your logistic cost. So logistic cost from 14% it comes down to 8%, 7%. That can give a lot of boost to this thing, corporate profitability. So everything to do with the corporate profitability. If my nominal GDP growth is growing, nominal GDP is at say 10, 11%. You remove the agriculture, so net of agriculture it might be more like 13, 14%. So if my corporate profit can grow, keeping that only, say my corporate profit GDP is about 5%, and that remains at 5. In US it is more like 9, 10% now. So if by chance that corporate profit to GDP, see in a bull run, in any economy, the corporate profit to GDP tends to accelerate.
Correct.
Because the cost cannot grow at the pace at which the nominal GDP is growing on a sustained basis. So that's where, say, GDP is growing at 12%, my sales is growing at 12%, my cost will grow at about 10, 11%. So operating leverage of some portion is left. So that's how the profit growth is a little faster, and that's why people want sustained GDP growth rate. And whenever it comes to stand still for some reason, global or local, you get a break and the market corrects it deep down, as if never it is going to come back.
Right. So today we still see upside in terms of corporate profit to GDP, right?
Looks like. That seems to be the mood right now. And second thing is that we are standing at a very interesting situation in terms of oil prices. Oil prices, despite all these tensions, still about $80, which is very strange. World couldn't have been more tense on oil. The whole action is out there. So, and then this fossil fuel, anti-fossil fuel environment. So, if by chance actually the renewables and all, they're able to replace a lot of oil. In that case, the commodity price, oil itself could be a little softer. And that can change fortunes of a lot of industries, because they're user of all sorts of petchem and as a raw material. So the margins might go up, But corporate profits are very complex thing. What is the bargaining power of the consumer? What kind of competitive forces are there? What kind of dumping is going on? What is my restrictive policies? If by chance you don't have any anti-dumping for steel and all, the profit will be very different.
In fact, that is a question I wanted to ask you, that now, everybody is talking about, China not being able to recover. The fact that they are giving fiscal stimulus.
They're doing at 5.2%. What more recovery you want? They said we'll do 5%. They've done 5%. Stock market, what is happening is a very different thing.
But economy-wise is okay.
At least
because one worry is that if they don't do the growth rate that they set out to do, then there is a possibility of dumping, which could sort of destroy a lot of industries here. Will that take away from our profits? What is the complexion of our industries?
Wherever you are competing with China head-on, you always have this threat. Even when you are doing well, there's always a threat that these guys can dump it and finish off the corporate profitability. But good thing is in services, they are not there. 60% of the economy is services. So all the services oriented or within manufacturing, whatever services, they're all uncompetitive. And then you have a lot of consumer goods. Again, there's no competition. There are only the industrials, tradable industrials like steel, particularly steel or other metals, some chemicals. That's where the real competition is.
Okay. Coming back to stocks, one area, for example, since we're talking about China play here, specialty chemical stocks, a few years ago, I mean, for a long time, this sector did really well because we were thinking that we will again take away this China plus one was playing out, and it is a global, we would be able to get a significant share of the global value chain and all of that. But suddenly, in the last 1.5 years, it has become very clear that, people are saying destocking and all of that is playing out, and stocks have gone down 50%. I mean, a darling stock like Divi's has seen this kind of erosion. Are these good buying opportunities, or when these sort of price erosion happens, does it mean that there is a reset that will take time for stock prices to stabilize or move back up?
Specialty chemicals are very company specific. So do we have global competitive advantage? Because you want to compete globally. You want to export, you want to consume, and doors are open for Chinese or European or whatever. See, one of the problems, there is one concept, Indian cost, American value. That's the beauty of Indian IT. You manufacture at $5, you sell at $25. There is enough margin out there. Because you are competing with American producers where $20 per hour is the minimum wages. So there the minimum wages for the competent guy is more like $60 to $80 or maybe even $100. Against that you are giving hardly $5 or $10. So you have a huge competitive advantage. Okay, but when you come to manufacture products, chemical or anything, steel or something, you are looking at Indian cost, Chinese price. Now Indian cost doesn't have the scale of China and subsidies and things of the China. How do you compete? Even an American manufacturer who would like to shift from China to India, yes, India is a great place to shift. But he's saying, give me a competitive price to China for me to shift. Now, how do I give a competitive price? So the margin will always be a challenge when you're competing in terms of price with China. You might get the volume. Any buyer from Europe and America will prefer Indian products. Okay, but they want Chinese price.
So all these segments that are being addressed with PLI, you think only is a makeshift or a tactical move, and they will not be able to...
Somewhere you have to do the beginning. You have to get some basic volumes. So government is saying that we'll fund you. But do the stuff here. Do the validation in India. So we will buffer you with some kind of extra profit, extra margin or extra incentive to the buyer to buy it from here. So your economics are not challenged. But it's a challenge. The government plus Indian manufacturer put together, are they good enough to see the competition coming from China? Because they are very passionate and very organized, and they have scaled up. It's like saying that if China tries to compete with India in tech side, it's very tough. I mean, we have solved a lot of problems. So as we go along, but you can't give up. As a country, you can't give up. You have to keep building up. Like they realize that logistic cost is very high. So let's build the logistics. So all the railways, all the roads, I mean, they are being built. Of course, it will have a sobering effect on my cost structure. So getting competitive advantage, global competitive advantage in manufacturing, I think that takes time.
So now this IT space, how do you see that? Because, about 10 years ago, I mean 2013, 14, 15, I think there was a lot of bad press around IT, that AI will come and disrupt and, jobs will go away and all of that stuff.
See, the challenge is for the large companies. Mid-sized companies, they'll be able to maneuver and they'll be able to see the IT spend is not going away anywhere. I mean, if the world is growing at 5%, the IT spend is also growing at 5%. Gartner and all these guys, nobody's saying that on a 5% US growth, nominal growth, the IT spend will degrow by 5%. No. In fact, there's more pressure on the IT budget. I mean, they need to do 6% or 7%. In fact, some of the IT chiefs, they were saying that why should it be stuck at 5% when the health insurance is at 12%? It should also rise because the need of the hour is the digitization. So they are asking about more budget, or at least as much budget. And then Indian cost structure, the competitive advantage is so high. Even the AI, who will make it happen for the companies? It's not going to happen on, AI is not a machine. Ki aap se aap ho gaya. You have to go and implement those solutions. AI implementation has to happen. That again will be done by Indians. We'll be the best guys in executing AI. Now the issue is that after using AI, the programming and all those, whatever the long cycle projects, can it come down in terms of timeline? Say instead of 90 days, can be done in 30 days or 10 days. And if it can be done in 30 days or 10 days, in that case, will the demand, since demand for software is unlimited. So when you bring down the price, the demand for the software will explode. So the explosion in the volume and the reduction in the cycle time for the software, I think it will work out brilliant for the Indian IT companies as we go along. That's my sense. But
so do you see value in those stocks, in that topic?
No, value means,
from a market perspective, do you see them as having a long runway of growth?
I couldn't understand what happened in this 2 days back, 3 days back, when the TCS and Infosys result came and the whole thing rocketed. I said the result is okay. I mean, it is as per the expectation, but there's nothing I see which we should take the market as if 10, 15. I think there was short covering. People are too bearish, too much shorted they had done against the rest of the market. So maybe some short covering must have happened. But I don't see any spark for the stocks to just fly. The trend, this is not a very trended industry right now. I think total budget is going to remain at full limit, and my sense is the budget is there. The disproportionate pie of that will come to India. Now, which company will get how much, it all depends on competencies and relationship they have.
So you would say you were bullish, positive on IT companies, IT stocks?
I mean, not in short term, big time, but I'm not bearish also. I think they are wonderful companies, and we must have some portion allocated to the stocks. It's a very high ROE, high free cash flow, extremely well governed, professionally managed, globally competitive kind of companies. So we must have in the portfolio.
Sure. One question on PSUs. If we look at the last 20-year history, I mean, PSUs are often, you buy them cheap, you will sell them also cheap. They never sort of go beyond a certain threshold in terms of valuation. Now we've seen such a huge run in PSU stocks in general, and definitely banks in particular. What are your thoughts on PSU bank valuations right now? Now, one of the fundamental premise of this whole rally is also the administration. If we assume that, PSUs will be revitalized or public institutions will be better, there will be reason to believe that they should also get higher multiples. That can be a case, but do you believe that could be the case?
See, Mahalakshmi, in 2000, I do this wealth creation study. So in 2004-5, till 2004-5, 50% of wealth was created by PSUs, 45 to 50%. Okay, then it started coming down. It looks quite crazy. It became zero last year. I said, either it is the end of this entire segment, but there's such large companies, it can't be end. So it had to reverse, I mean, all these oil companies at some 20,000-30,000 crores. I mean, their Bombay office would be worth that much, types. So clearly there was too deep of value. And when market is on fire, I mean, if by chance, in Mumbai, Nariman Point goes up by 2x or 3x, I mean, even Andheri and Borivali will also go up by 2-3x, howsoever low they might be, or howsoever far they are. So it is like that. So in the market, I mean, the value discovery keeps happening. So, if there was anything left 6 months back or 9 months back, after first flush of bull run, at the index of about 17,000-18,000, I mean, it was all the PSUs only, and that's how the market went about discovering them. They were in any case 5-7% dividend yield, P multiple of mid or low single digit. So it was a crying value. I mean, if you can get, any company at 5 P multiple, and the companies are large monopolistic companies, what stops you? I mean, you'll earn your dividend or you'll earn the earnings in just 3-4 years, your purchase price. So clearly there was the deepest possible value, and it was very unpopular for whatever reason. And companies, irrespective of the performance, they kept on becoming lower and lower in value. And now it is reversing. So the character of the PSU, will remain same. Whatever their problems were earlier, I don't think it is getting sorted out immediately. I don't see anything happening. But what market did was also unreasonable, which they are correcting.
Is that part over, or do you think,
people who are smart, they bought at the bottom. Somebody had it. Right. Okay, apart from LIC, also some people had it.
Right.
So yes, they have been lucky. I have not made much money out of that. Let me be frank. And
why
I'm
did
sure
you not? Because you are a value investor.
I was
So
a
you are
value,
like-
not value investor, but this management hang up in my mind. What is the quality of management? It was always hovering, and that kept me away. But some of the asset-light businesses like defense companies, construction companies, they were fabulous in terms of return ratios. So I think the growth is also coming from there with a very aggressive allocation for railways and infrastructure build-up. Some of these companies. And in defense, what choice you have? I mean, government will favor defense companies, monopoly defense companies.
Right.
So I would think that they have still some steam left. So right now they're in limelight not for their corporate performance. They're in limelight for re-rating. And re-rating, I told you the story. The de-rating had happened so deeply, it is reversion to the mean. Once the reversion to mean is over, then the noise will come down, it will subside.
Okay, it's time for that to happen now.
That time has come now.
Okay. And how do you size up this opportunity between private banks and public sector banks? For quite some time now, HDFC Bank has been an underperformer. And I think at the beginning of the conversation, you said it in a different context that, leadership can make a lot of difference to the fortunes of a company and a country. The market has not taken to this leadership change very favorably.
Which is rightfully so also. I mean,
so is there reason now, should we be comparing it against a 10-year average P, or what is the case then? I mean, if the market is resetting expectations, is there credibility to the fact that...
So, story for both of them are different. Opportunity for private sector bank, winning market share from PSU bank, that continues. Okay, but they have to have their own challenges of leadership change. Now, if the leadership transition happens, it takes few years from a wonderful management to, again get to that, the new guys who come in their shoes, they're expanded banks, lakhs and lakhs of crores of liability and assets and all. So it takes some time for transition and all. And our regulators have been very strict on the old management anywhere around the bank, which I find, challenging for the transition. The transition to the new management is not, I see in my company that how the transition will happen. These are all huge companies, global sized banks, billions of dollars. So for the new management without the supervision of the old management is very tough. So that is the pain we are going through now. Now the transition has to happen without the supervision of the old guards. So, it is tough. And at the same time, the economy is also flying. And there is a massive competition. PSU banks have also come back. The books are clean. In COVID time, nobody's book is left uncleaned. Correct. Every book is clean. Correct. So now everybody's balance sheet is as pristine as can be. And opportunity is there. So they have their liability franchise. So they are giving tough competition to private sector banks. So at that point of time, if
so
your leadership
on balance,
is weak,
what looks good now? Is it as a basket?
So you have to go bank by bank.
You
have to go bank by bank. Somewhere you get good leadership. Somewhere you get very low valuation. Somewhere you get very good growth. You get good leadership, good franchise, good growth, reasonable valuation. So it's all combination. Banking sector is going to grow. You'll get opportunities there. But you have to figure out where is I think the sunset of the leadership, that has become a new surprise. And that is taking the entire sector energy out. Because if the largest of the banks are passing through transition and they don't scale up in terms of valuation, then others can't scale up, no? Even if they perform well.
What are the other long-term themes that you're really positive on?
See, one of the biggest thing which has happened in last 30, 40 years, I'm in the market for 40 years. I've never seen a change, what we are going through. So, post-COVID or during COVID, the KYC was, the physical KYC was given a pass and digital onboarding started. And suddenly every month we started getting 10x customers from 0.4 million to 4 million.
Right.
And so that time the total Demat account was about 40 million. And I think unique must be 1/3 or maybe half. So just about 20 million. From that 40 million, now we have reached 140 million. In 3 years flat, so 30 million every year. my sense is, so there is a massive network effect. When these people are coming, they're coming with maybe 30,000, 50,000, 1 lakh. Some big ones are also coming. So the now markets have gone to tier 3, tier 4, and in some cases probably villages also.
Right.
I have not gone to, I would be shudder to think about villages.
Right.
But I think tier 4, 5 tak to pahunch gaya pakka. So now the intensification of this thing is happening. So my sense is we are in for next 5 to 7 years, this 140 going to 280 or 300 million, 30 million each. So, and the existing guy is giving more money because performance is very good. Performance will come to about say 15%. These are all assumptions. If 15% return comes in the market, and it is 3x to your fixed deposit. So obviously people love this, and people will come. So there will be self affirmation of what they are doing. So finally, the shift from pure banking to capital markets will happen. So instead of putting your money into bank deposits, you will start putting some portion in the capital markets, into mutual funds or stocks and things like that. And that is also one of the pain points for the banking system.
Right.
You know, and this is not going to stop, let me tell you. This is going to become very vigorous as the participation depth goes in and people test the power of equity in India. Now what it does, that you starve for till about 2020, there was an acute shortage of equity for the entrepreneurs.
Right.
We were pushing it somehow, was owned or whatever little we had, some people they had. And if your equity is not there, it is a challenge for the debt also. That's why the whole thing was very hollow in between 2010 to 2020. There was no equity in the large projects. Now, you have excess liquidity, as much equity you want, because people are coming, they're bringing the hard-earned savings, and here the market is also at a very interesting level.
Right.
I would say fully priced, but very warm, very nice.
Right.
So your primary market is fully open.
Right.
I have 4,000 corporates, and SEBI has no role to play in follow-on offerings. So there is not much of bureaucracy out there.
Correct.
Straight in 30, 40 days you can tap the market.
Right.
So there is a good supply, there is a very predictable demand in the market, which is going to become only bigger, and there is a very good supply. You know, supply building up. FIs, they have lost 3% of market share, and my sense is net they'll keep losing market share. I don't think they'll buy, because they have other markets which are much cheaper.
Right.
But domestic money will stay here.
Right.
So my sense is they will stay where they are. Net they will neither buy nor sell. So domestic money will take care of the market, and it will horizontally expand. So it's a very interesting time. My only fear is market should not become parabolic, the way it happened in 1992, the first bull run. Those lessons and the challenges and problems of first bull market is still not over. We are still called sensitive industries. You know, I don't want to create another problem. I don't want to see another problem.
Right.
That will finish our career otherwise.
Right.
So this one is a wonderful opportunity, golden opportunity, and probably the forces of liquidity injection in the market is far bigger than 1990, maybe 10x. But this liquidity is high quality and very distributed. It is not likely to go back if we don't misbehave.
I was asking you, what are the other themes that you are really bullish on?
So
one you said is wealth.
So so all to do with the capital. My sense is the
anything related to capital markets.
Sector for next 10 years is going to be capital markets. Whether it is broking, whether it is asset management, whether it is depositories, whether it is exchanges of all. I mean there are a whole lot of other participants. So all this, because they are asset light and then growing, very high ROE. So I think, and market has not capitalized them well. So my sense is this is the sector to watch. Then you have the, other rest of the financial sector will also do very well. Like your insurance products will do well, health insurance particularly will do well. So I see a lot of scalability in the financial side, whether it is capital market or non-capital market, lendings and those kind of things.
So one theme is financials. Anything else?
Then you go to the manufacturing, other, say all this capex boom. So you have all the capex, general as well as very specialized ones, railways, your defense, your infra build-up. So all those capex companies will do well. Then I would think that finally...
In terms of stock market performance, you think they'll be in the next 2 to 3 years
They'll all
will
do
be able
well.
to make money?
They'll all do well. Then there is a massive wealth effect because the stock markets have done well. So all the people who are holders of shares, I mean, of course, promoters first thing, and then large HNIs and all, they have seen appreciation beyond their imagination. So they would open their purses. Somebody will go and buy a big house. First call is a house, then the travel, then the gaddi. So all this trickle down will happen, and finally then trickle down will be so big that even bottom of the pyramid will be, and the biggest thing will be the government tax collection will be very good. By 1 lakh or 2 lakh crore, it will be higher than whatever government is estimating. That will allow government to push up, even social sector spending as well as the capex for infra, and that will have a huge. So I think all this put together, one is the usual, 7% growth. So classical, the growth strategy for services, manufacturing, and government expenditure and those kind of things. And second is the wealth effect. So there will be twin engine. One is the classical engine, and second is this new engine of the wealth creation from the stock market. And that wealth effect, whatever it percolates down and creates a new demand. Demand for all the luxuries. Look at the real estate. And the companies were 3 years back, in 2020, they're all bankrupt. Literally, they had no face. Today, all the companies are firing up. So this is a change which is coming from the top down.
Right. So related to manufacturing, is there any particular segment? You talked about power earlier. Is that a space that really excites you?
Yeah, see, in power, the demand for power, now I think yesterday or day before they were saying that we want assured 24/7 power for India. Right now, availability in urban centers are more like 20 to 23 hours, but I think rural India still has a 4-5 hours gap. So there is and credibility of the system to be improved. It's a very good promise to make to this thing in next 5 years. So I think the power generating capacity has to be built up. So again, we are talking about building some more thermal power plant. Renewables, in any case, they are roaring. So that has a huge cascading effect. All sorts of utility companies as well as the capex companies. So in 2008, what happened was power, cement, they were the big capex, kind of a private sector capex. First flush of what you call liberation for power sector, and this time it was completely missing so far. Now, because the demand-led power shortage is leading to yet another start of setting up power plants. So NTPC and all of them, they will float the tender for thousands and thousands, and now base is also different. So even 10% additional power is like 30, 40, 50,000 megawatt of power. So running into 1.5 lakh or 2 lakh.
You would think this will be a multi-year trend? Power could be a multi-year trend?
It looks like. It's a global shortage. It's not only India, and power is one thing you cannot import. And as your economy is surging at 7%, I would think power demand will grow at 8 to 9%, 10%. So where is that kind of capacity?
So you are saying that we are probably at the 3rd year of the bull run. How do you really reorient your portfolio at this stage?
The first thing is I'm allocated fully, as I said earlier.
Correct.
So I'm sticking to that.
Right.
So these things are quotational loss for me. See, the only fear is that it goes parabolic up 8 times or 10 times, and then it drops by 50%. So but nobody wants to.
Just to ask you, can that happen?
What
are the risks?
It will happen. It has happened 3 times. There is no reason why 4th time it will not happen. It's the nature of the market. We are living for that only. It will happen. It is inevitable. Do you want it? I don't want it.
Do you see it in the next 12 to 18 months?
I don't see it. You've seen this, no? This is historical. This will repeat in a bigger way or a smaller way. Because this time we have SEBI. We have digital systems. We have very powerful SEBI. And they can make or break whatever. So I think that the parabolic growth in the indices, they would try to prevail upon that somehow, using their whatever power they have in their hands. But greed is greed. Greed can overpower even SEBI. So I would think one day they will.
So, but it is too soon to call that.
Yeah, right now things are still sensible. 20-21 P multiple. See, multiple can sustain even at 30, I'm telling you.
Right.
If Indian GDP growth goes to 9% and my corporate profit GDP goes from 5% to 8%, then I deserve much higher multiples. So So then you get sucked into like Nikkei. In 1990, it went to 39,000. This is 2024. Still they are not through. So, those kind of possibilities are there. But it's all show. You have to watch. When I was in the market in 87, 200 crores was the daily turnover. Today it is 400 lakh crores per day.
Right.
So how more, what is called exponential? I think one has to come and see in NSE volumes.
Correct. Is there any one thing that you can call out that really worries you?
One is this volume of options and kind of complexity of it. The rest all is fine in the sense that we are going very well. It should just not become parabolic. Otherwise, we are fine. There will be corrections. There will be 1 or 2 years of no return. That will be good. That will be healthy. But I don't think I see a disaster at this.
Any surprises you expect in this budget? What do you expect at all in this budget?
She said it is a vote on account. I don't expect...
It's an interim budget.
It's an interim budget. So they'll wait for 2 more months. Why to try to strain your brain when they are saying that there is nothing? I think I would look for the expected GDP numbers for the next year. What they are projecting, like what RBI governor just said. So these numbers will all translate into budget. 7% GDP growth rate and all. They are very good.
This year, what could surprise markets and what could disappoint markets?
Which year?
2024.
2024,
If
25.
you would say.
24
calendar, I'm saying.
Yeah.
So 3 things that could surprise markets and 3 things that could positively surprise markets and disappoint markets.
See, very committed. See, one big event is elections. Post-election, how the FIs behave. If they actually come back, because they are feeling left out, and if they come back, they'll come back with $40-50 billion because they've burned enough money in China now. So they will come back here. My sense is. And that can have a very huge impact on the large caps performance, which has been somewhat muted in the past. So that could be one positive surprise, I would say. When they sell, nothing is going to happen. It is a business as usual type. Let them sell. Doesn't matter. But if they come back with a vengeance with $40-50 billion, I think you'll see a lot of action. It can change the character of the market. Even it can shift from mid and small to large. Because ultimately they'll go where the money is being made. So
otherwise, you don't see this shift from small and mid cap to large on its own. Without FIs coming in.
Or some regulatory interventions are there in terms of their definitions or something like that. So that is one. The corporate profits performance, can it, say like oil coming down sharply or interest rates being cut very sharply. Those are things which can, I don't think US interest rates are going to fall that fast. But if by chance they were to fall by 150 basis points in 1 year, you have a lot of, again, it will play into all sorts of things.
Right. And what could disappoint? 3 things.
I'm always worried about the corporate earnings. Because if corporate earnings are intact, whatever happens in the market, it's all quotational. It will come back. So I'm worried about the corporate profits. And again, I'll be reading almost all the results this quarter also. Because I don't think 7% GDP means 11-12% nominal. And I should very comfortably get 15 to 17% earnings growth. But I don't think that's there in the price. So it is all to do with the corporate profits.
Sure. All right, Raamdeo ji, thank you so much. It was a wonderful discussion. Thanks so much.
Thanks.